June 2020. A private jet sits on a runway, engines already turning. A man boards alone, no luggage that matters, heading east toward Belarus. Behind him, in Munich, a company worth billions of euros is coming apart in real time. Somewhere, 1.9 billion euros that were supposed to be sitting in bank accounts in the Philippines have simply stopped existing. The man on the plane is Jan Marsalek, Chief Operating Officer of Wirecard, once one of the most trusted names in European finance. He will never be seen in public again. Interpol will issue a red notice with his name on it. But 3 weeks earlier, Wirecard was still a member of Germany's DAX, still worth more than Deutsche Bank. To understand how it all fell apart, you have to go back to the beginning. In 1999, on the outskirts of Munich, in the town of Aschheim, a small payment processing company called Wirecard set up shop. The internet was still young. Online shopping was a novelty, and somebody had to build the plumbing that let money move safely from a customer's card to a merchant's account. Wirecard positioned itself as exactly that plumbing, quietly processing digital payments for businesses that banks considered too risky to touch. Online gambling sites, adult content, other high-margin, high-scrutiny corners of the internet that traditional finance avoided. It was not a glamorous start, but it was profitable. And crucially, it gave Wirecard a foothold in a business model that would define the next 2 decades. Payment processing as invisible infrastructure, running in the background of a boom nobody could stop. By 2006, the company had grown enough to join Germany's tech DAX, the index of the country's leading technology firms. That was the first signal that Wirecard was no longer a niche outfit. Under Chief Executive Markus Braun, an Austrian engineer with a doctorate and a taste for turtlenecks that drew comparisons to Steve Jobs, the company began an aggressive expansion. It acquired banking licenses. It moved into prepaid cards, mobile payments, point-of-sale systems. It positioned itself as Germany's answer to PayPal, a homegrown fintech champion in a country whose financial sector was otherwise dominated by century-old banks. The growth numbers were extraordinary. Wirecard reported soaring revenue and, more importantly, soaring profit, much of it credited to a fast-growing business in Asia, a network of third-party acquiring partners who processed payments on Wirecard's behalf across markets. The company said it could not enter directly. On paper, this Asian operation was a gold mine, generating margins that dwarfed what any comparable Western payment company could produce. By 2018, the transformation was complete. Wirecard was promoted into the DAX, Germany's blue-chip index of 30 leading companies, replacing Commerzbank, a lender with roots stretching back more than a century. It was a symbolic passing of the torch, the old German banking establishment stepping aside for a fintech upstart barely 2 decades old. At its peak, Wirecard's market value pushed past 20 billion euros. For a moment, briefly, it was worth more than Deutsche Bank itself, the most storied name in German finance. Investors who had bought early were sitting on extraordinary returns. Analysts wrote glowing notes. Politicians pointed to Wirecard as proof that Germany, so often accused of missing the tech revolution, could still produce a world-beating digital champion. Jan Marsalek, the company's chief operating officer, became the public face of its international ambitions. Charismatic, well-connected, always traveling, always closing the next deal in Singapore or Manila or Dubai. Braun ran the numbers and the narrative from Munich. Marsalek ran the world outside it. Together, they had built, on paper, one of the most valuable financial technology companies in Europe. The problem was that a significant share of the profits driving that valuation were coming from exactly the part of the business that was hardest for outsiders to verify. The first serious doubts about Wirecard did not come from regulators. They came from journalists. Starting years before the collapse, the Financial Times began publishing a series of investigations alleging that Wirecard's accounts did not add up. Reporters raised questions about the size and substance of the company's Asian operations, about round-tripping of money between related entities, about whether the profits Wirecard was reporting from its third-party partners in places like the Philippines and India were real at all. Whistleblowers came forward. Internal documents surfaced, suggesting that some of the numbers had simply been invented. Wirecard's response was consistent and aggressive: deny everything, and attack the credibility of the accusers. The company called the reporting a coordinated campaign by short sellers, investors who profit when a stock price falls, designed to drive down its share price for profit. It was a plausible-sounding defense, and for a long time it worked. Short sellers are unpopular by nature, easy to cast as villains, and Wirecard leaned into that framing at every opportunity. What made the years that followed genuinely strange was the behavior of Germany's own financial regulator, BaFin. Rather than launching a serious investigation into the company at the center of the allegations, BaFin took the extraordinary step of temporarily banning short selling of Wirecard shares, an action normally reserved for moments of systemic market stress. Then it went further. It filed a criminal complaint against Financial Times journalists and scrutinized the short sellers raising the alarm, rather than the company they were raising the alarm about. To outside observers, this looked less like regulation than protection. Wirecard was, after all, one of Germany's proudest fintech success stories, a DAX member, a symbol of the country's digital ambitions. Questioning it too loudly started to look almost unpatriotic. Politicians and much of the German financial press treated the Financial Times reporting with skepticism bordering on hostility. Wirecard's stock, after brief wobbles, kept climbing. The DAX promotion in 2018 happened after the allegations had already begun. Inside the company, the structure that made the fraud possible was hiding in plain sight, described in every annual report, but somehow never fully interrogated. The most profitable part of Wirecard's business was not the part Wirecard actually ran. It was outsourced to third-party partners across Asia, companies with limited public profiles, whose books were not independently audited to the same standard as Wirecard's own. And the cash those partnerships supposedly generated, some 1.9 billion euros of it, sat not in German banks but in trust accounts in the Philippines, overseen by intermediaries, verified mainly through documents that Wirecard itself provided to its auditors. Ernst & Young had signed off on Wirecard's accounts for years. Each clean audit became another piece of armor. If the world's auditors believed the numbers, why shouldn't investors? The company's aura of legitimacy grew with every audit cycle it survived, even as the specific escalating allegations against it were never resolved, only buried under denials, lawsuits, and a regulator that seemed determined to look the other way. By early 2020, the pressure that had been building for years finally found a crack it could not paper over: the audit itself. Ernst & Young was preparing to sign off on Wirecard's accounts for the 2019 financial year, the same annual ritual that had reassured investors for more than a decade. But this time, when auditors tried to verify the 1.9 billion euros the company claimed to hold in trust accounts in the Philippines, they could not confirm it existed. Not a discrepancy, not a rounding error, a fifth of the company's balance sheet gone from view. Wirecard scrambled. Executives pointed to two Philippine banks as holders of the funds. Both banks stated on the record that they had no relationship with Wirecard at all, and that the documents purporting to show the deposits were not genuine. The Philippine Central Bank confirmed the money had never entered the country's financial system. On 18th June 2020, Wirecard postponed publication of its annual results. The next day, Ernst & Young refused to sign off on the accounts at all, a virtually unheard-of rebuke for a DAX company. The share price, which had held near record highs just weeks earlier, began to disintegrate within hours. On 22nd June, Wirecard finally admitted what the numbers had been screaming. The 1.9 billion euros likely did not exist. It was an admission that unraveled not one bad quarter, But the entire premise of the company's Asian profit engine, the very business that had justified its valuation, its DAX membership, its claim to be more valuable than Deutsche Bank. Marcus Braun resigned as chief executive. Within days, he was arrested by German prosecutors on suspicion of fraud and market manipulation, taken from the company he had built over 2 decades and led in the same turtleneck for the cameras just months before. Jan Marsalek did not wait to be arrested. As the company came apart, he traveled first to Austria and then onward, eventually surfacing in Belarus, deep inside the sphere of a government notoriously resistant to European extradition requests. He has not been seen in public since. German police issued a warrant. Interpol placed him on its list of most wanted fugitives with a red notice attached to his name. Subsequent reporting has linked him to Russian intelligence networks, though he remains to this day missing. On 25th of June 2020, Wirecard filed for insolvency. It became one of the first companies in the DAX's history to collapse outright, a blue-chip firm erased from Germany's most prestigious index not by a takeover or a merger, but by fraud. Nearly 2 decades of growth, a market value that had once eclipsed the country's oldest bank, dissolved in a matter of days once the one number nobody could verify was finally checked. What was left of Wirecard did not take long to disappear. The insolvency proceedings unwound the company piece by piece. Its payments business, the one part with genuine operating value, was eventually sold off in fragments to other firms. The DAX listing was gone. 20 billion euros of market value had evaporated, and with it, the savings of thousands of retail investors who had trusted both the company and the regulator that was supposed to be watching it. Marcus Braun has stood trial in Germany on charges of fraud, embezzlement, and market manipulation, facing prosecutors who allege he oversaw the falsification of accounts for years. He has denied the core allegations, insisting he too was deceived by subordinates. Jan Marsalek has never faced a courtroom. He remains a fugitive, believed to be living under the protection of interests in Belarus, and, according to later reporting, tied into networks connected to Russian intelligence. He remains on Interpol's list of most wanted individuals, a red notice with his name and face still active, still unresolved. Of the 1.9 billion euros, essentially none of it has ever been recovered. For Germany, the reckoning went beyond one company. BaFin, the regulator that spent years investigating journalists and short sellers instead of the fraud they were describing, faced international ridicule and a domestic overhaul of how German financial oversight works. The Financial Times reporters who had been targeted with criminal complaints for years were, in the end, entirely vindicated. Wirecard is now taught as a case study, how a DAX company, audited every year by one of the world's largest accounting firms, could report a business worth billions that simply was not there. The mechanism was almost old-fashioned in its simplicity. Invented profits, dressed up in the language of Asian growth markets and third-party partnerships, verified mainly by documents nobody outside the company controlled. What made it extraordinary was not the sophistication of the fraud, but the scale of the institutions that failed to catch it or chose not to. The country that once held up Wirecard as proof it could build a fintech giant to rival Silicon Valley instead built the largest accounting scandal in its post-war history. Somewhere, presumably, Jan Marsalek is still out there. The money isn't.